Taxes have been around in one form or another for thousands of years. The first known system of taxation goes all the way back to ancient Egypt in 3000 BC. Back then, the pharaoh would tour his kingdom every other year and collect 20% of everyone's crop harvest. And ancient Egyptians weren't very happy to pay taxes. Today, our modern tax system is much more complex. Because the government is continually tinkering with our tax system, the Internal Revenue Code is 6,550 pages long, and that doesn't include the 7.7 million words of tax regulations that are used to interpret those pages. There are generally three categories of tax treatment for your retirement savings. Taxable, where you pay taxes every year on your earnings. Tax deferred, meaning you don't pay taxes until you withdraw money. And tax-free, where you do not pay taxes on your earnings at distribution. Each category has different rules, different tax treatment, and different advantages and disadvantages. But all too often, many people have all their retirement savings in just one or maybe two categories. And when tax rates or rules change, you might be unable to make adjustments to your retirement income. Consider siblings Bill and Jill. Bill owns a traditional IRA. Jill owns a stock. When Bill takes money out of his traditional IRA, he must pay ordinary income taxes on the total amount he withdraws. Jill, on the other hand, when she sells her stock, will pay capital gains taxes on just the growth of the stock while she owned it. For Bill, his ordinary income tax rate can be as high as 37%. But for Jill, her long-term capital gain tax rate maxes out at 20%. Bill received a tax deduction in the year he contributed money into his traditional IRA. Meanwhile, Jill didn't receive any tax deductions when she bought her stock. Complicated, right? Now consider if Uncle Sam increased the tax rate on ordinary income, but left capital gains tax rates the same. Suddenly, Bill's taxes on his traditional IRA would go up, but Jill's taxes on the sale of her stock would remain the same. The result is that Bill would have fewer dollars in his pocket than Jill to pay his bills in retirement. That is why a retirement strategy that includes a strategy of tax allocation can be important. Much like you may use asset allocation to diversify your investments, tax allocation diversifies your retirement plan components into vehicles that are taxed differently. That way, should tax rates or rules change for one part of your retirement strategy, you could shift to using retirement funds from another area.
Thanks for watching that short animated video on taxes. In fact, we know taxes are going up. Folks will debate back and forth. They don't think they will, and they think they are, back and forth. But we know, in fact, that taxes are going to go up when the Trump tax cuts expire. I'm Joe Zingone, the Realistic Economist. What we're going to try and do is give you some insight into how to keep your taxes in check. And you got to remember, the tax code is written in pencil, which means there are frequent changes to the tax code. Matter of fact, they're almost, I would say, weekly changes. This is very, very important. Now, it's important, as the video went to stress, to understand the strategy of tax allocation and its cousin, asset allocation. Now, a lot of folks are very familiar with asset allocation. That's the 60-40 split, bonds versus stocks. You want to get that balance. So that's asset allocation. But what's really overlooked, it's very, very important, or maybe more important, is the actual thing on tax allocation. Now, what we need to understand is tax allocation is the new core, the new basis for all our financial decisions. If you look at it through strictly asset allocation, you're not going to really come up with the best answers. You need to look at it through the tax allocation strategy. Every decision must be seen through a tax side. In other words, you've got to understand how tax rate the effect is today, and also what the tax effect will be in the future if rates rise. Now, taxes and healthcare costs will probably be one of our biggest expenses going into and during retirement. But being prepared will allow you to go to those different tax the different tax baskets to get your living expenses, which is very important. I'm certified by the New Jersey Department of Education to become a CPA, and I understand the tax consequences and really look toward the tax allocation strategy as a solid answer going forward. Now, what I'd like you to do, if you have any questions about tax allocation strategies and about taxes, or how to keep your taxes down, you can just send me a quick email at joe@realisticeconomist.us. Again, that's joe@realisticeconomist.us. Thank you.